Marcus had been investing in a regular brokerage account for 8 months. Every 2 weeks, $200 went in, bought index funds. He felt good about it. Then his coworker Deshaun mentioned casually that he'd gotten what amounted to a $4,000 free raise from work this year. Marcus asked what he meant. Deshaun said, "401k match, you're getting it too, right?" Marcus went quiet. He had no idea what Deshaun was talking about.
I checked my HR portal that afternoon. My employer offered a 401k match. They matched 100% of my contributions up to 4% of my salary. My salary was $52,000. $4% of $52,000 is $2,080 per year that my employer would contribute dollar for dollar if I contributed the same. I had been with this company for 11 months. My 401k contribution, $0. I had left $1,906 in free money sitting on the table.
The 401k employer match is the single best guaranteed return in personal finance. If your employer matches 100% of your contributions up to a percentage of your salary, contributing anything less than that maximum is turning down free money. It is an immediate 100% return on your contribution before any investment growth occurs. Nothing in the financial markets offers a guaranteed 100% return. Nothing.
Let's start with the basics. A 401k is a retirement savings account offered by your employer. The money you contribute comes from your paycheck before taxes are taken out, which means your taxable income is reduced by the amount you contribute. You contribute, the money grows tax-deferred, and you pay income taxes when you withdraw it in retirement. The tax deferral accelerates compound growth significantly.
The math on tax deferral is powerful. If Marcus earns $52,000 and contributes $3,000 to his traditional 401k, his taxable income drops to $49,000. In the 22% federal tax bracket, that $3,000 contribution costs him only $2,340 out of pocket, because $660 comes from reduced taxes. The government subsidizes your retirement savings. This is the gift buried in the tax code.
But here's what confused me. Julian said there's also a Roth 401k. Same employer account, same match, but you contribute after-tax dollars. No immediate tax break. But when you withdraw in retirement, 0 taxes. All the growth, all the gains, completely tax-free. Same account. Completely opposite tax timing. I had to ask which one is better.
Traditional 401k, pay taxes later. Roth 401k, pay taxes now. The right choice depends on whether you expect your tax rate to be higher now or in retirement. Young people earning relatively modest salaries who expect their income to grow significantly over their career are often in their lowest tax bracket right now. For them, paying taxes now at a low rate and enjoying tax-free growth is often the better long-term bet. Roth, when in doubt, early in your career.
The 2025 contribution limit for a 401k, $23,500 per year. That's the total you can contribute from your paycheck. Your employer's match is on top of that. If you're under 50, $23,500 is the ceiling. Most people don't reach it, and that's fine. The priority is first, contribute at least enough to capture the full employer match. That is non-negotiable. Beyond that, the IRA comes next.
The IRA, individual retirement account, is separate from your employer's plan. You open it yourself with any brokerage. The 2025 contribution limit, $7,000 per year. Same 2 flavors, traditional IRA, where you may get a tax deduction on contributions depending on your income, and Roth IRA, where contributions are after tax, but all growth and withdrawals in retirement are completely tax-free.
The Roth IRA is the most powerful retirement account for most young Americans, and I want to be very specific about why. Every dollar that goes into a Roth IRA grows completely free from capital gains taxes, dividend taxes, and ordinary income taxes in retirement. A $7,000 contribution at age 25 that grows at 8% annually becomes approximately $218,000 at age 65, and every dollar of that is yours, tax-free.
Roth IRA income limits. In 2025, single filers earning above $165,000 begin losing eligibility, and those above $180,000 cannot contribute directly. For most people in their 20s and 30s, this is not a constraint, but it's important to know. The Roth IRA window may close as your income grows. Using it early, before your income potentially outgrows the limit, captures years of tax-free growth that can never be reclaimed.
The order Julian gave me. 1. Contribute enough to the 401k to get the full employer match. 2. Open a Roth IRA and max it out. $7,000. $3 if I still have money left to invest, go back to the 401k and contribute more. 4. Anything beyond that, regular taxable brokerage. This order maximizes tax advantages before putting any money in accounts that will be taxed on gains. I'd been doing step 4 first.
Marcus had been contributing $200 per month, $2,400 per year, to a taxable brokerage account, generating capital gains taxes on dividends and future sales. He should have been putting that same $200 into a Roth IRA where all growth would be tax-free. The amount was identical. The account type made the difference. He'd been paying voluntary taxes on his investment growth for 8 months without knowing it.
Elena worked as a freelance designer, no employer, no 401k. Julian showed her the solo 401k and the SEP IRA, retirement accounts designed for self-employed people and small business owners. A SEP IRA allows her to contribute up to 25% of her net self-employment income, significantly more than a standard IRA. For a good income year, that could be $15,000 or more, all tax-deductible, all growing tax-deferred.
The HSA Health Savings Account is available only if you have a high-deductible health plan. If you do, the HSA is arguably the most powerful tax-advantaged account that exists because it offers triple tax benefits. Contributions are tax-deductible, growth is tax-free, and withdrawals for medical expenses are tax-free. No other account gives you 3 tax benefits simultaneously. Contribute the maximum, $4,300 for individuals in 2025, and invest it.
Most people treat the HSA like a medical checking account, contributing and immediately withdrawing for current expenses. The sophisticated strategy: pay current medical expenses out of pocket, keep receipts, and let the HSA grow invested for decades. In retirement, you can withdraw for any expense, tax-free for medical, taxed like a traditional IRA for non-medical. Keep the receipts and reimburse yourself tax-free years later.
The power of tax-deferred and tax-free compounding is not intuitive until you see the numbers. 2 investors each contribute $6,000 per year for 30 years. Investor A uses a taxable brokerage, pays 15% capital gains tax annually. Investor B uses a Roth IRA, pays 0 tax, same contributions, same 8% annual return. At the end, Investor A has approximately $490,000. Investor B has approximately $680,000. The account type, not the amount invested, created a $190,000 difference.
I made 4 changes in one afternoon. 1. Enrolled in my employer's 401k at 4% of salary to capture the full match. 2. Chose the Roth 401k option because I expected my income to grow. 3. Opened a Roth IRA at Fidelity and set up a $400 per month automatic contribution. 4. Redirected my old $200 brokerage contribution to the Roth IRA. Same amount, different wrapper, completely different tax outcome.
The 401k's investment options are limited to what your employer's plan offers, typically a curated menu of mutual funds and sometimes index funds. The IRA opened independently gives you access to the full universe of investments. This is why the IRA is particularly valuable. You choose the provider, you choose the funds, you choose the strategy. For index fund investors, this means access to the lowest cost funds available.
Vesting schedules apply to employer 401k matches, not your own contributions. If your employer has a 3-year vesting schedule, their matching contributions only fully become yours after 3 years of employment. Some vest gradually, 33% after year 1, 66% after year 2, 100% after year 3. If you leave a company before full vesting, you lose the unvested portion of the match. Check your plan's vesting schedule before making job change decisions.
Early withdrawal from a 401k or traditional IRA before age 59.5 triggers a 10% penalty plus income taxes on the withdrawal. $10,000 withdrawn early could cost $3,500 or more in penalties and taxes, reducing $10,000 to $6,500. The Roth IRA has a partial exception. Your contributed principal, not growth, can be withdrawn penalty-free at any time. This makes the Roth IRA also a flexible emergency backstop of last resort.
The required minimum distributions rule. At age 73, traditional 401k and IRA accounts require you to start withdrawing a minimum amount each year, whether you need the money or not. The government wants its tax revenue eventually. Roth IRAs have no required minimum distributions. You can let them grow your entire life and pass them to heirs tax-free. Another reason to favor Roth early in your career.
Catch-up contributions exist for people 50 and older. The 401k catch-up in 2025, an additional $7,500 for a total of $31,000. The IRA catch-up, an additional $1,000 for a total of $8,000. These provisions exist because many people undersave in their early careers. The tax system provides an accelerator for the final stretch before retirement. But using it means you underfunded your early years, when compounding had the most time to work.
Elena opened a SEP IRA and contributed $8,000 in her first year, a portion of her freelance income, fully tax-deductible. That $8,000 reduced her taxable income by $8,000, saving her approximately $1,760 in federal taxes. The $8,000 is invested in index funds and will grow tax-deferred. She received an immediate 22% guaranteed return in the form of tax savings, before the market moved a single point.
The backdoor Roth IRA exists for high earners who exceed the direct Roth IRA income limits. You contribute to a traditional IRA, no income limit for contributions, just for deductibility, then immediately convert it to a Roth IRA. This workaround is legal, widely used, and endorsed by tax professionals. The tax code is complex enough that legal optimization is available to those who look for it. This is one of the most commonly used.
Target date retirement funds, available in most 401k plans, are the simplest valid approach for investors who don't want to choose allocations. You pick the fund dated closest to your expected retirement year, a 2060 fund if you plan to retire around 2060, and it automatically manages the allocation, shifting from aggressive stock-heavy to conservative bond-heavy as the target date approaches. One fund, set it, leave it, it works.
Marcus's updated financial picture after 1 year of tax-advantaged investing: 401k balance, $4,160, including $2,080 of his own contributions and $2,080 of employer match. Roth IRA balance, $4,800, invested in a total market index fund. Emergency fund, $5,200 in high-yield savings. Total investable assets, just under $10,000, built in 1 year, built correctly, with the tax structure working for him instead of against him.
The thing that bothered me most looking back is that the 401k match was in my employee handbook. Every document I signed when I was hired explained it. I just never read it. The information isn't hidden. It's in writing in your HR portal in your benefits guide. The cost of not reading your benefits documents, in my case, $1,906 in my first year alone, is real, specific, and recoverable only if you catch it.
Tax optimization is not tax evasion. It is the deliberate legal use of tax code provisions designed to encourage retirement savings, home ownership, education, healthcare, and charitable giving. Every tax-advantaged account 401k IRA HSA exists because Congress decided to incentivize specific behaviors. Using them as designed is not a loophole. It is the intended use. The government built the on-ramp, you just have to get on it.
When Marcus started investing, he was doing the right thing in the wrong account. His index fund strategy was sound. His contribution discipline was real. He just hadn't learned that the account wrapper matters as much as the investment inside it. Two investors can hold the exact same fund, contribute the exact same amount, for the exact same 30 years, and end up with dramatically different after-tax wealth based purely on the account they used.
The tax code is the operating system of American personal finance. Understanding it doesn't require a degree in accounting. It requires knowing which accounts exist, what their limits are, and what order to fill them. The 401k employer match, then the Roth IRA, then more 401k, then HSA if eligible, then taxable brokerage. This sequence, followed consistently, produces dramatically better outcomes than investing blindly.
I called my mom and told her about the 401k match she'd been leaving behind for 6 years at her job. She enrolled the next week. She had 12 years until retirement. Even 12 years of her employer's 3% match, compounding in an index fund, would add tens of thousands of dollars to her retirement that didn't exist the week before that phone call. Sometimes the best investment you make is the phone call you make for someone you love.